Welcome to the Compounders Podcast. On this show, we explore the topic of compounding from various angles, including through interviews with public and private company executives, investors who focus on compounders, and newer investment firms that are building a business they hope will become more valuable over time.
All opinions expressed by the host and the podcast guests are solely their own opinions. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We're not recommending the purchase or sale of any securities. The host and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable. My guests on the show today are Michael Demaray and Vishal Mishra of Bard Associates, a boutique wealth management firm that has been in business since the 1980s. Michael and Vishal are true value investors who like to look in places other investors neglect. Specifically, Bard invests in a space that is near and dear to my heart, U.S. microcap stocks. In this informative conversation, we discussed the strategies that Bard runs today for its clients, the firm's long history of investing in small companies, why some microcap stock prices are so volatile, the common characteristics of a core Bard holding, and the firm's approach to interacting with company management. And without any further ado, here's my conversation with Michael Demaray and Vishal Mishra of Bard Associates. A lot of our listeners are not going to be familiar with Bard Associates. Would you give us a little background on the history of the firm?
Sure, yeah. Bard is a registered investment advisor in Chicago, Illinois. It was started in 1982 by Tim Johnson, who's our founder. He was working at a firm at the time called Northwest Industries, and I guess he was spending a lot of time picking stocks. And I think a lot of these stories, he had friends and family who were coming to him, and at some point he said, I'm just going to do this full time. So we serve individuals and families primarily through individual accounts, and we focus specifically on investing in small companies.
And I know you offer both wealth management and investment management services. How do those work together and complement each other?
Yeah, the investment management is putting the capital to use and to its highest and best use. That's what we're trying to do. And the wealth management is really there as a function of our client base. We have, again, like I said, individuals and families, and they have needs that extend beyond just where do I put my money to work. That can include cash management, that can include coordinating with their estate planner, titling their accounts, asset location. A lot of what we do is kind of the day-to-day logistics of managing people's money, not just picking stocks.
And how has the firm evolved over time? Like, what are any major changes or shifts or new strategies launched, and anything that people should be aware of as they're thinking about, putting this firm into context?
Yeah, the interesting thing is I think that we've been doing something very similar for over 40 years, which is, again, investing in small companies. And I think our industry has evolved quite a bit, as you know. I see a lot of other wealth managers today kind of outsourcing the asset management function or the stock selection function, putting clients into products or, model portfolios. And we, again, haven't changed that much. We're out there trying to find the individual companies. So I'm not sure that there's been dramatic change. I think if you stepped into our office today, it might feel the same as it did 30 years ago. So yeah, I would say the firm has not gone through a lot of change.
And you mentioned that you focused on small companies. Talk to me about what that means. Like, what are the core strategies that you're running today for investment management clients?
Our core strategy is primarily, we have an aggressive strategy and a defensive strategy. The aggressive strategy is focusing on small publicly traded companies, so small cap, micro cap stocks. And on the defensive side, that's really just a ballast for client portfolios. We're focused more on publicly traded income, securities, and then of course we do cash management alongside that.
Right, and so there's always maybe some disagreement in terms of definitions of what small means today. Like you see, Wasatch runs like a $2 billion microcap strategy, right? So, what is microcap and what is small? But I'm curious, like when you say small and microcap, what does that mean to you as a firm?
Yeah. So I would say that the first thing we need to recognize is that because we're not institutional investors, we don't have like a mandate from the top down. Every constraint that we place is one that's uh, we place on ourselves. That said, internally, we've looked at companies with sub $500 million market caps, but I think we're, a little bit flexible around that, in part because I think the interest is more in value creation. So if we find something slightly above that, we're willing to look at it. But that's kind of been our kind of line of demarcation. I think 500 million in market cap.
And do you have any perspective for people who are thinking about investing in kind of sub 500 million market cap companies today, how that landscape has changed, whether that's from the companies and whatever, whether that's about the companies in that space or investor appetite for these companies, or, I'm just curious because it seems to me, given my personal experiences, that, this used to be maybe more of a core part of a lot of firm strategies to invest in these size companies. And now it's less so. So I'm just curious, like, as you think about this firm's history and how that universe that you focused on has changed.
Oh my goodness. Yeah, you're very right. I think the number is what there used to be 7,000 publicly traded companies, and now it's down to what, 3 or 4,000, and 90% of the attrition has happened in small microcap companies. So with the rise of private investing, this is definitely changed. Our universe has changed. I mean, I think in the 1990s, 15% of publicly traded companies, or sorry, in the Russell 2000 were unprofitable. And now I think it peaked around 45% sometime in maybe 2022. I can't remember the exact numbers, but there's been a dramatic shift in the composition of small and microcap. I think biotech is funded in a way that it wasn't historically. So you have all these cash burning companies now in the small microcap bucket, which we don't do any biotech, but that takes up a big chunk of it. So I would say, yeah, the opportunities, it used to be, I wasn't there in the 1980s investing in this space, but I think it was more like shooting fish in a barrel back in, Peter Lynch could run, 100 or 1,000 companies or whatever he ran in his portfolio and do very, very well. Obviously, he was very talented, but I think it's a different world today. I think that you have to be a lot more selective in what you look at. If you look at the market as a whole, even at the market as a whole, it's probably like 5 to 10% of firms are creating the majority of the value. And that's certainly true in small microcap space. So you're looking at 100, 200 firms out there that are really going to make the difference down in the size. And you're just, I guess if I was talking to somebody who was interested in this space today, I'd be thinking, you have to be highly selective when you get down here.
You kind of double clicking on that point. How do you think about what I would call adverse selection risk, which is that in a lot of ways there were some great public companies in this space and some went away and the good ones got bought, and what you're left with is an inferior pool of companies. And by the way, this is a question I answer all the time. So I just want to hear your perspective of it. Like, why is this still a good pool to fish in, or pond to fish in is probably the right word. Given the, I think, whether it's perceived or real risk of adverse selection.
Yeah. Yeah, that's a great question. And we debate this internally a lot too. I think there's a couple places to go with this question. The first thing I'd say is that I agree that the index itself is sort of an adverse selection index, right? Like the best companies graduate out of the index, and then you're left with kind of these ones that don't do well or are subscale. Part of a key tenet of our strategy is to not sell them when they get big. So we are participating in the gains of those businesses that graduate out of our market cap space. So I think the one thing is you don't want to get rid of these companies that are actually successful. That's where your upside comes from. And so that's where maybe there's a mismatch between the index of small microcap companies and then the actual opportunity for the investor. Because a lot of them get out of that space. If you sold them all, then you'd be in trouble. The second thing I would say is we we look at everything through the lens of value creation, right? So we're looking for, if you think about investor returns come from two sources, valuation and corporate performance. And corporate performance is driven by, we think, three things. Like, can this company earn an excess return? Um, what is the reinvestment opportunity at those high excess returns? And then is there some durable competitive advantage that will protect those returns for the long run? If we think about small companies, that kind of reinvestment runway, what we're trying to do is find those companies young in that reinvestment runway, so they have a decade or two ahead of them to reinvest that at those high rates of return. And oftentimes, because we're in the small space, we're looking for emerging competitive advantages or emerging high returns. They may not even be earning positive returns on invested capital yet, but we're looking for ones that we think can in the future. So, yes, it's an adverse selection pool. I think you have to be completely aware of that, but you also have to know what you're looking for within that pool, and eliminate everything else.
You mentioned it being highly selective. When you do get your hands on something and put it in the portfolio, how have you thought about how much how much of a portfolio a single positions should make up, and maybe talk a little bit about, like, if you have different position sizes for entry positions versus like more full positions, just give us a sense for position sizing and concentration.
Yeah, we've been pretty diversified. And this is kind of, I think Tim learned early on that you are going to have a lot of losers in this space. That just kind of comes with the nature of the game. And you have to make sure that your winners pay for your losers. So, um, it's okay to not get it right 100% of the time. Um, so we size positions, I want to say between 1% and 2% for an initial position. And then we can add to that position over time, I think, as we get more comfortable. We don't have any hard and fast risk management rules. And again, because we're running individual portfolios, a lot of times we can work with individual portfolios to either, add to our overall holding of that company in an underexposed portfolio. So that's how we think about it.
And does that usually shake out kind of in the 40 to 50 stock range?
Yeah. Yeah. That's probably where we end up for the individual portfolios. Although as a total firm, we probably have, in this aggressive strategy, we probably have 100 names. So,
Interesting. Okay.
yeah.
And so we've talked a little bit about the evolution of the microcap space and um, the degree to which maybe some of the best companies are no longer there for any number of structural reasons. But when someone hears microcap and they say, "Oh, it's the netherworld of the public markets and it's almost uninvestable," like, what do you think people are missing about the opportunities that exist in this space?
Again, first of all, I would say it depends who you're talking to, because it is uninvestable for a lot of people. Like, if I was an institution of, a couple $1 billion, like, yeah, you couldn't come down here. And therein lies the opportunity for people like us, right? Um, so for those people, I'd say you're right for your situation. For other people who can invest down here and choose not to, I would say, again, I understand why you wouldn't want to be here. Like, there's you have to be careful. There are lots of landmines. You have to, it requires patience. The information, I feel like, and Ben, you can tell me your experience in this. It feels like sometimes it takes the market a little bit longer to digest and update. So you have to be more patient, right? You can sit on something for years where you can see the underlying fundamental progress of a business, and the market just won't care for that long. So it's not for everybody. I think you have to have the right mindset for it and know what you're getting into.
And you hinted at limiting capacity, right? You don't think you can raise a $2 billion fund and invest here. How have you thought about the capacity of the microcap strategy, a microcap oriented strategy?
Yeah, Vishal and I were actually debating this back and forth over the last couple of days, and I think it's somewhere. I think you could run it might feel uncomfortable at times, but I think you could run $500 million in the space. Again, you have to be willing to be patient. You also have to be willing to sit in things that might not be working for the time being that could potentially go to zero. But I think that you could run 500 million in the space.
When I think about running that much money in a space where you face a lot of illiquidity in some of these securities, it makes me curious about how you typically source liquidity. Are you kind of the buy it every day guys? Are you buying blocks from times? Are you contacting people to see if there's shares for sale? Because I think is an underappreciated and underdiscussed aspect of microcap investing is, first of all, it's the difficulty of finding liquidity versus, kind of being up market cap, but also the alpha that can be generated if you are able to source blocks from motivated sellers. So talk to me a little bit about that.
Yeah, we definitely, I would say, do all of the above. Oftentimes we're buying directly from the companies themselves, either around an uplist or a secondary, or more recently, and I credit Vishal for this, we've been reaching out directly to companies that we know have an ATM in place, and we're in, active dialogue with them about their capital needs. Especially, we find companies we like and we go to them directly and say, hey, listen, we're here on the other side. We're not going to charge you a banking fee. We're not going to, it's not going to be, we'll do an at the market deal. It's not going to be crazy discount. And they seem receptive to that. So sometimes it's very difficult. You're right. We'll get into a market. We might find a company that we really like. The worst case scenario is it's traded on a foreign exchange and you're in the market every day and there's no liquidity. And, sometimes we have to give up on getting into something that we really like. But yeah, we're trying to use all those different paths that you mentioned to get to liquidity and just get a position.
And you mentioned being patient. And when you're in a liquid situation, that requires some patience. You may take a while to get out. So, but as you're initiating a position, what is your desired hold period in most cases? And maybe you can, if there is, you can bifurcate that between, different types of securities, maybe something that look more like a compounder versus a statistically cheap stock. Maybe help us think about how the portfolio is constructed when you're talking about hold periods.
Yeah. I mean, in my ideal world, we'd always be holding for really long periods of time. We always joke and say that we want to hold them forever, but that's obviously not going to happen. We've had a few where we've held for decades. We've been fortunate to have a couple compounders where we've been able to do that for decades. My preference, if I'm given two companies, then I think one could be a potential compounder and one is statistically cheap. I'm going to take the compounder all day long, just because, I won't have the reinvestment risk. I won't have the liquidity risk of getting out. I won't have the reinvestment risk of having to reinvest that cash when the company re-rates in, if you're lucky, a year or a couple of months. So I would skew towards the compounder side versus statistically cheap side. And we want that thing to compound as long as possible.
Within that dynamic, right? Price is going to matter and valuation is going to matter, right? The compounder may not be priced the same as the super cheap, mediocre company. How does valuation play into all of that, which we're discussing right now as you're choosing, thinking about putting securities into the portfolio?
Yeah. A lot of these companies are really small relative to their opportunities. So I think that we're obviously little less valuation sensitive on the compounders, because what we found is that when you're investing in the small microcap space, a lot of times, because you have companies that aren't profitable yet, there's no obvious competitive advantage for some of these companies. They haven't scaled yet to have high ROICs. They're not, you don't have the same valuation issues that you do if you were looking at a comparable company that was a large cap or a mid cap. So we feel like we get kind of two benefits. One is we're getting a lower valuation on a comparable basis. Yeah, we might not have scale economies. We might not have is obvious a competitive advantage. But when the business actually works and it scales, you're going to get a re-rating on the valuation because all of a sudden this thing is inflected to a positive return situation. And you're going to enjoy that kind of longer growth, longer reinvestment runway. So you get kind of both the underlying fundamentals improve and the valuation improves.
I mean, you find one of those compounders and you put it in the portfolio and you're kind of investing behind it. Is there a point at which you start to get nervous about, oh no, we own 7, 8, 9, or we go over 9 in the company? Like, is that a conversation that happens as you've become maybe a bigger and bigger shareholder within the company?
Are you talking about percentage of ownership or percent of our portfolio?
Percentage of ownership.
I think the only things that we've only been sensitive about is that 20% mark because of the mandatory 13D filing and then some of the monitoring requirements around that. And so that's the only threshold that that really kind of makes us take a pause. Other than that, I think we're comfortable. Anything up to that. We're not activists. We haven't really got involved with with companies from that perspective. So we just happen to be, greater than 5% shareholders in some situations.
When you are in those situations where you do have some meaningful stake and you potentially have some influence, how do you engage with management? I mean, are you mostly passive, or is there a suggestivist element? Tell me how you engage with management within, especially when you have the ability to maybe throw your weight around if it was necessary.
We'll let the management know what our opinion is. We're never like threatening a proxy fight or, we've never done anything like that. That's not to say we couldn't in the future, but it's not really something that we've done. We are pretty honest with them about, our perspective. We try to use our position to dialogue with them honestly, to tell them where we think they're doing a great job, to be constructive in areas where we think they can improve. And oftentimes what happens is we're in dialogue with other shareholders who oftentimes we get reached out from another shareholder who might have an activist bent. And then in that situation, we'll listen to them and talk to them about that situation. But we're never initiating activism, and we've never been part of a group. So
one of the things you mentioned that was interesting to me, and it's totally true, is that you're diversified because you're expecting that no one bats 1,000, and you're going to be, if you can be right 65% of the time, you're probably doing pretty well for your clients. I guess in my experience, one of the more, maybe not more often, but if something goes wrong with small companies pretty frequently is some kind of capital allocation mistake, or issues that are more tied to the business, to the management and decisions made by management than what's going on in the business. So I'm curious how you've approached the management assessment side and making sure that the people, especially in these smaller companies, are kind of aligned and understand or at least from your perspective, how to create value for shareholders.
yeah, I think that I wanted Vishal to weigh in on this one too, because I think he's got some perspectives here. But part of it's just understanding what their plans are. What are they gonna? Can they articulate how they are going to create value? If they can't do that, then I don't have any hope that it's going to happen, because it's not going to magically happen out of nowhere. So oftentimes it's just like, you tell me how you're going to create value out of this particular situation. And if I get a platitude back, or, some nebulous, statement, then that's nowhere near as good as somebody who's like, well, I'm going to buy this piece of equipment. It's going to save this much inefficiency. I'm going to be able to take the spinning heads out. I'm going to sell off this division. So I want concrete kind of steps of what this what this person thinks that they could do. That also tells me that oftentimes that things are under their control versus they're at the mercy of the market, which might tell me something about the business itself. Am I a price taker? Am I at the losing end of, am I at the mercy of the whims of my competitors or the marketplace itself, or can I actually affect my own destiny? So, Vishal, do you have any thoughts on that, friend?
Yeah, I think when we look at businesses, they might be in different like phases of their evolution. So some business may need you know an operational turnaround. Some business may need what you alluded to, Ben, capital, like some low capital, high capital consumptive, low ROC business needs to be chopped off because they see a higher, better. So that's a capital allocation piece. So so yeah, so we say, what does this business need at this point of time? And the growth will come because they need to fix their own operations, or they need to do a better job of sales and marketing, or like have they reached the business has reached the potential as it is, and the next phase could be acquisition. So well, then he needs to have they. So depending on what the businesses need to grow, and whether those competencies management is bringing to the table for that particular business, and we try to assess that. And over very, very long periods, of course, capital allocation, because we hold for decades, the amount of capital management has allocated exceeds the amount of capital in the business. So over very long periods, capital allocation is the most important skill, which makes a difference to the business.
I'll tell you one thing I didn't appreciate. Tim Johnson will always joke that he's too patient with companies, that he'll hold them way past the time he should. But as a result of that, I've seen now several times where a company that we probably should have sold a long time ago gets a new manager. Then all of a sudden, like, the story completely changes 100%. One company that we do own is Mama's Creations, right? And Adam Michaels came into there, having been in CPG and having been in Mondelez and doing M&A there. And he walked in the door and, assessed the situation, completely optimized operations, and now is kind of on a growth trajectory. And he really turned that business around. And now we've seen that a couple times with a couple different situations. I mean, one we didn't own, but owned at one point, before his time was, Jason Veith at Laird Superfoods. Again, coming from White Wave, getting rid of all their manufacturing, outsourcing it to co-packing, outsourcing logistics to 3PL, taking all those costs out of the business and focusing on their core competency. Like, what a difference that made for that business. And then we're seeing it again, not a name that we own that much of. We may have a few shares of, is Innovative Food Holdings. Pretty early. Bill Bennett's coming from Kroger. Again, professionalized management coming down into a stock that's just kind of flatlined for a long time, getting rid of their mail order business and focusing on the specialty food distribution. I just think that it's amazing to me that you can have a business that's that can go nowhere for so long, and then a manager comes in and completely changes the trajectory, which again speaks to how important management is in this market cap size. It's very, very important.
Sucker for the big company guy comes into a small company story. And so we've had both Adam and Bill Bennett on the podcast. So if anyone's interested in listening, you should check those out. Two very interesting leaders and two, interesting stories that, one of which has played out, I think, relatively quickly with Mama's, and with Bill is taking a little longer, but the path and the runway, and the story sounds similar in a lot of ways. I want to talk before we talk a little more about the portfolio. I just want to touch on governance for one sec, because it is, I think, really important. Of course, you've got there's some big tech companies that still have AV structures, but I would say in a lot of situations, it is microcaps where you see some bizarre governance structures and controlling shareholders. Just give me a sense, is that something you guys shy away from? Are you okay with kind of investing in controlled companies? Do you like the owner operator model? Just where does that fit within the portfolio construction?
I think it's something that we're cognizant of, and we assess every situation differently, right? Because some of those situations are fantastic, and some of them are perverse. So you have to you have to look at them each on their own merits, and figure out if you're in a situation that's going to be good for common shareholders or not. Yeah.
Understood. So let's talk a little bit about the holdings. So when I look at your holdings, it's a very eclectic mix of companies. And, when you're looking at them, it doesn't immediately stand out how all these fit together. So I'm just curious about the common characteristics of the companies that make it in the portfolio today.
We are true generalists. In terms of common characteristics, what we try to do, I would say, is again, apply that value creation framework and think if we can visualize that this company could be really big. And in process of getting really big, it's going to have operating leverage so that the return profile improves and hopefully it re-rates in the process. So I would say that's the common characteristic of what we try to do. Now, do some things get through our filter? Probably that shouldn't be there. I'm sure they do, but that's really what we're trying to do. Occasionally we'll end up with like a deep value situation or, a pure value thing, that's in there, or a special situation. But overarching, we're trying to, find companies that can get a lot bigger.
When it comes to the process of you find something and determining whether it could become a lot bigger, I think there's always a risk of just listening to what management says or what sell side says about it. Like, how do you supplement your understanding of that market opportunity outside of what comes directly from the company?
I think there's a lot of like internal debate that happens with the team where we try to kind of push on the assumptions, and see if there's other third parties, whether it's just our own research trying to figure out whether that makes sense. And, I think we try to get better and better at that every day. My background's in consulting. One of my first jobs was, proving out market sizes and, that sort of thing, looking at competitive landscapes. We're trying to do that a lot more, trying to figure out, what's the competitive landscape look like? Can they even compete in this market? I think that's a big problem for a lot of small companies is there's an 800-pound gorilla. So we're trying to put it through all, the competitive analysis sort of frameworks. I think that Vishal and I were just talking about this last couple of days. It's like, okay, if you took like Hamilton's 7 powers and which ones would apply to small businesses and which ones do they fail on? And I think we really said that the ones that they really fail on, of course, are scale, and network effects are difficult, I think, at that size. But really all the other ones are up for grabs. If you think about that framework, like a lot of times these small companies have a counter positioning advantage, right? You've got an incumbent. I mean, a perfect example of this, I think, is the company we own, BK Technologies, right? They make quad band radios for municipalities. They've kind of have a history in forest fires, and being embedded there. And now they're going after like tertiary municipal departments with a product that is significantly cheaper than Motorola solutions. Well, that's kind of a thing where Motorola can't really respond to the competitively because they either have to lower their price or they have to go after municipalities where it's not really worth their time. So you've got that kind of perfect counter positioning situation. So in that case, we're trying to just use our brains to think through the specific situation and figure out if it makes sense.
When you mentioned being generalists, I'm curious if there are sectors that just intellectually and philosophically you gravitate towards and maybe away from. when you're trying to figure out what belongs in a portfolio?
I mean, who doesn't love software, right? Like asset light, great margins. So that's one we gravitate towards. We don't touch biotech, don't touch anything that we don't understand. Deeply cyclical companies we try to stay away from. Financials, we stay away from, and companies where they're kind of susceptible to commodity prices. We stay away from often.
It's funny because it sounds like you're investing in businesses that are getting more valuable over time, and I mean, at least that's the goal. But one of the issues within this market cap spectrum, I think, is that volatility is part of the game. And so, as I'm reading through your letters, I see, just these very large moves in a single quarter, either up or down in some of your companies. Given the strategy of not investing in kind of like cyclical, commodity-based, statistically cheap stocks, like why are businesses that are, by and large getting more valuable over time so volatile from your perspective?
Yeah, I mean, I think again, because they're so early in their life, and we talked about some of the liquidity issues. If somebody big wants to get out, they're gonna destroy the share price.
Yeah.
And it may have nothing to do with the underlying fundamentals of that business, or if they have a bad quarter or 2 quarters, or some bad news comes out, and there's a stampede for the exits, things are gonna move, or you stampede in or stampede out, things are gonna move. And they do, they just do. They move that. We try to kind of not, we try to take advantage of the volatility, obviously, with meme stocks these days. We've been in many situations where all of a sudden you wake up and something's up, 100%, and you have to at that point make an assessment about whether you want to be around for the ride or you want to just get out. And oftentimes we will head to the sidelines because we know we can get a better price at some other point. But it's, fortunately, because we're so diversified, like I mentioned, clients don't really feel it the way that I think you might feel it if you were looking at just a handful of names.
Yeah, it is institutional. I mean, as you said, Ben, the institutions have left this sector. Some news, sometimes there's no news and stock will be down 15%. And nothing happened just because somebody wants to get out. So what we do is we first run diversified, and our clients trust us. So that helps us stay in the business for the long term. So that's how we deal with it on our portfolio management side, and we take advantage of it. We said there is no liquidity, but liquidity comes in these names when the stock is down a lot or they have grown become big. So there is liquidity, and we take advantage of that depending on what we think about the business.
And what are the, I think, inherent attractions, but also the flaws of investing in this market cap space is that if a company does well, it's likely to get taken from you, right? If you found it early and before there were some kind of emerging competitive advantages, they start to be appreciated by the market, potentially competitors or private equity firms or other buyers become more cognizant of those, whatever the success of that company. And inevitably it gets, a lot of these businesses are going to get taken from you. Is that part of the strategy? Is that just an inevitability? How do you think about that kind of both the risk and opportunity associated with things being taken from you?
I mean, there's nothing I hate more than waking up to an announcement of a company that I really love that's going to get acquired. I mean, I do feel like if you're trying to compound for a long period of time, you don't want that interrupted and then have to redeploy the capital because it took you so long to find that company in the first place and to get used to it. So yeah, you're right. That's kind of a bummer. I mean, I think we did kind of an internal informal assessment of our IRRs of companies that were taken out, and it was somewhere on average of like 26% or something like that, and the median was maybe around 13%. I don't remember those specific numbers, but it's definitely not something that we want to happen. But you're right, it does happen.
And just to add, Michael, just to add, the numbers are from the analysis. We had like 120 transactions, companies who were taken over in the last 22 years. And, average IRR was, 25% on those, So, our companies may not, the market, the way institutional investors have left our business may not be recognized by the market, but the strategic buyers, they recognize the value, and we see that like them pop. So on average, 5 takeovers per year. That just shows how the value is being recognized by somebody else if the market does not recognize it.
Sure. Yeah. I mean, it's it's part of the game you're playing. And I think I wrote a Substack piece or article one time. It's like, buy a business that no one else wants to buy. And that sounded like a joke, like buy a bunch of bad businesses, like just but find something that someone else doesn't want to buy so it can compound, so it doesn't get taken from you. I think that's I think it's a funny story. One thing we've talked a little bit about some ideas you own and companies that you've been involved with, but I'd love to kind of double click and hear about what you think of as an example of a quintessential Bard stock, and that can be past or present. But I'm curious, like what in the portfolio today, or what's an example of something that's just like typifies the kind of businesses you want to be invested in.
Yeah. Vishal, do you want to take this one? We both talked a lot about this. Yeah.
Yeah. So I mean, I would say a quintessential Bard stock example is Tyler Technologies. Just our involvement with it, we bought the stock below $3, late 90s, 2000, held it for 25 years, sold it in 22 for like 190x. And generated 23% IRR for our clients. So that's a very quintessential Bard stock in the sense that it'll give you a history of what happened. Tyler Technologies was involved. It was a conglomerate of business doing like auto part retailing, some gifting for school systems, and but then the management, new CEO came in, and the new ownership also changed, where they recognized, this providing software for government customers like municipalities, for property tax records and judicial systems and law enforcement systems, that's a better business. It's a very choppy business. It does not come up for RFP all the time. And they recognize that there's a high ROE and a much better competitive situation. The bigger ones, Oracles, they don't compete in this because so it does not come up for renew upgrade all the time, and they just can't do it. Government customers, they do it, and they want to have an end-to-end solution and keep it for several years till they really need to change it, and then again do an RFP process. So it's like a slow-moving market. And it was very fragmented at that point of time. So Tyler came in. They initially acquired more products, which is on these government verticals, and then went around going across geographies, and that has been just like a home run for our. And that's the kind of business we like to own: high ROEs, very good capital allocation, and it worked out great for our clients.
Something doesn't work. Oh, sorry. Go ahead, Michael. If you want double.
Oh, I was just going to say, Vishal kind of, obviously neither Vishal nor I were here when that decision was made. That was preceded us. But Vishal is very good. We joke that he's like the firm historian. He went through and made us kind of all read like case studies on that particular subject. And it was just fascinating to read about that transition at that point, right? You got this auto parts retailer and this, the high school gift business, and the company, somebody had to make the decision that we're going to sell these things. And then you talk about kind of governance issues. I think one of the software companies was bought from a board member. I can't remember the story exactly, but it was like there's some related party transaction in there. But there were two wonderful businesses that they bought to them. But the absolute vision of a CEO who says, no, we're going to get completely out of this stuff and get into way better businesses. You don't see that a lot. But it's kind of a cool story to see that from the genesis and then to see where it landed 30, 40 years later for that business.
And that's a story about a stock that went incredibly well. Let's turn that around a little bit. When things don't go well, how do you think about sell discipline? When you typically selling these companies, is it permanent capital impairment? Is it a change of strategy? Like what's causing you to sell? And I think you can't in this space talk about selling without talking about like functionally, how do you get out the door, right? So maybe talk a little bit about how we talked about sourcing stock to buy, but maybe talk a little bit about liquidity when you're trying to sell.
Yeah, I think that again, the idea that sometimes we're too patient and we're willing to let things go to completely to zero if need be. We don't always do that. We try to recognize things early, right? Like we try to ask that permanent capital impairment question pretty early and hopefully before others see it, although obviously that's not always possible. And at that point, I think that, I think what every investor struggles with, which is like, yeah, there's that temptation to price anchor, right, to where things used to be. And then we just have to say, like, no, I can't see a future value for this business. We're willing to exit, even if it feels like, you know, we're, it feels like we could get a better price in the future. I would like to say that because some of these companies are so small, a lot of times the situation in front of us is an existential one. So, and at that point, I'm happy to get any price above zero. So sometimes, you don't want to blow the stock out, but I'm a little more willing to kind of just walk away with whatever we can salvage. But yeah, there's been a lot of times where we let things just go to zero. There's been a lot of times where we have left a business, and there are those times where you take the facts in front of you, you exit because you think there's a permanent impairment of capital, and something changes in the future and the stock goes up. And you can't beat yourself up over those situations because you make the decisions with the facts you have at the time. And if it was the right decision, then it was the right decision. So.
Sure. And you guys have a relatively small team. I'm curious how you segment the universe and cover the universe and maybe create a watch list so that it's manageable for a small team to cover as many companies as you could potentially touch.
Yeah, that's a process I think we're always working on, which is like, how do we create our pipeline or our funnel or however you want to talk about it so that we're monitoring the companies and not losing track of them. I think the first thing is it's a big universe, and the most important thing in my mind is to cut off the left tail. Like, don't spend any more time than you have to on things that aren't going to be productive. I think sometimes, not always, there's a temptation to overthink certain situations, right? Like, oh my goodness, is there some hidden value that I'm missing? Is there some sort of, did I not, do my sum of the parts correctly? Can I squeeze a little bit more out? Well, I don't want to spend time on that. I just want to look at, does this business show operating leverage? Is it growing the top line? Is it, and if it's not, then like, let's set it aside and we can revisit it again in 6 months or a year to see if things have changed. But we're always trying to cut off the left tail and spend our time wisely with the things in the portfolio. We probably spend more time on our problem children than we do kind of on the companies that are performing well. But you're right. It's a lot of names to cover for a small team, and we're trying to get more efficient all the time in how we do that. So,
Do you have an estimate of the companies that are potentially in your universe? How many of them are potentially not? I'm talking about liquidity. I'm talking about like, this is a business we could really own, as opposed to, I know for a fact we could never own this. Is that hundreds of companies? Is it dozens? Like how many theaters really are in your universe?
Yeah. I mean, like if I just had to guess off the top of my head, I'd say somewhere around 200. Vishal, what would you say?
Yeah, that's about right. Yeah, and to reinforce what Michael was saying, we have to say no quickly. Is to have those quickly say no. we can revisit it, but based on what we are seeing right now, we just say no and move on. And the ability to say no and have filters in place so that we do not, like, whatever percent, very high, like 80-90% is not great. We have to we know we have to focus on those 5 or 10% names which are good, and then we know as soon as we say, oh, it's probably belong to the other 90% bucket where we need to say no, we need to move on to the next one. And that's and we are trying to get more and more efficient at that process almost on a daily basis.
You never like to leave a conversation with a manager without discussing a mistake. And I personally have made a lot of public investing mistakes, as everyone on this call has. I'm just curious if there's one that you would highlight that you've said afterwards, I'm never going to do that exact same thing again. I'll make more mistakes, but it's going to be new and different versus that thing. Anything that's been really searing and profound that you guys would want to talk about?
I think we both want to answer this question. I think that for me, there's just, I guess I could probably bucket my mistakes, bucket them into categories. One is value traps, right? Like something that's like very optically cheap, but maybe it's not a great business. And I've had this more on personal experience than with bar names, but like, there's one time I got involved with the shipping company, and it turned out to be a huge winner for me personally. From a financial perspective, it was one of the worst mistakes that I've ever made in hindsight, right? Because it was just one of these companies that it was cheap on paper, price to cash flow basis. But it wasn't a great business, and it had vulnerabilities that ultimately came out. And I was fortunate enough to exit at the time, but boy, did it feel like a dicey situation when I was there. And I don't think I'd ever do that again, for sure. So staying out of value traps, staying out of companies that have existential risk attached to them, which usually comes through the balance sheet or key customer risk. The other thing I would say is, like, a lesson that I've learned is, not paying attention to product market fit. Maybe you've got somebody with a better mousetrap, but like, there's no reason for the market to adopt it. Science experiments, those kinds of companies, just staying away from. So again, these things that can consume your capital and time in a way that's not going to be rewarding over the long run. Those are kind of the big lessons. Vishal, what do you have?
I would add that, and I would say, orientation, which is whether the strategy and the management is long-term oriented versus short-term oriented. So my example, and it's still public, so I don't want to like badmouth. Example, they had a batch computing using renewable energy sources, so they would supply power to the batch computers, and the idea was to give a batch computing ability to universities for their data for the compute intensive computations or pharmaceuticals, and that sounded great. But cryptocurrency mining seemed like, at that point of time, oh, let's just use this to mine cryptocurrency when the computer is sitting idle and we are waiting for customers. Wow, that business worked great when and that seemed like. But then, just digressing from what you originally set out to go, which was more long-term oriented business, versus now, because now your computers don't have a use, many of the power, and run cryptocurrency mining on it. Well, all that looked great when the Bitcoin prices were going up, and then it went down a lot in 2022. So to me, just like, what is your business, and you stay focused on the businesses which is for the long term, as opposed to some quick buck making opportunity came, and you try to focus too much on that, and you took your eyes away from the long term. So I think the orientation, be long term oriented in your business. That's what we would like to see in our companies and management teams.
Those are great answers. With our remaining minutes here, I'd love to kind of close with a couple State of the Union questions about the investment universe you're focused on. So you guys have been investing, and not to you personally, have not been in the Bard seat for 40 years, but this firm has been investing in smaller companies for a long time. I'm just curious how you would categorize the current environment for finding interesting opportunities in this space relative to other environments that you guys have been involved in? Or maybe from, Vishal's historical understanding of the markets in where this company, the firm has participated. I'm just curious, like how you put the current moment into context.
It's funny. I was at lunch. This is kind of an indirect answer to your question. I was at lunch today with somebody at a bulge bracket bank, and we were joking that, like, if you asked any person in finance, like, where they would recommend for a young person to go look for a job, they would always tell them some job that was other than their own. Because when you're sitting in your own seat, you know how hard it is to do what you're doing. And so I think, we invest in the microcap space, knowing what kind of all the downsides are, the pitfalls. And I would say that the state of the union is the rise of privates have made it more difficult in this space. The attrition of publicly traded companies has made it more difficult in this space. That said, I would say you don't have to invest in the 2,000 smallest stocks. You can invest in a subset of them. So yes, maybe it's not like shooting fish in a barrel, but there's still opportunity. You don't need to have a 200 stock portfolio. You could have a 20 to 40 stock portfolio, which is still a smaller subset of what I would call the investable part of our universe. So it's, there's, maybe it's not as easy as it used to be, but that doesn't mean that there's not opportunity. And then also don't shoot yourself in the foot by getting rid of the companies that actually do start performing and grow larger. Continue to hold those and let those compound for you. So I think if you do that, there's still opportunity down here. That's what I would say. Vishal, you have thoughts on that one?
Yeah, I mean, there are lots and lots of, like Heiko, it's a $37 billion company, was a microcap just not too long ago. I mean, I gave you Tyler Technologies, Collectors Universe, in phenomenal business. It was taken private just a couple of years back. So just from more recent examples, is Celsius, which was a microcap and become so. There are lots and lots of opportunities to find great businesses. You just have to say no to the bad ones and focus on the good ones.
And then I think the other thing about this is, like, by the way, NVIDIA was a microcap 20 years ago, right? Walmart at some point was a microcap. I think that, one thing that I've appreciated more and more being here is it's hard to envision what a company is going to look like 10, 20, 30 years out. Like, these competitive advantages are emerging. There are businesses today that are sitting in microcap land that will be multi-billion-dollar businesses, household names in 10, 20, 30 years. It's just very difficult to see it today even for us who play in the space all the time, but trying to have the imagination of seeing where these companies can go and the patience to be with them for that period of time. It's not an easy thing to do, but I think the opportunity exists.
You answered my traditional closing question, which is about what's most underappreciated about the investment opportunity. I think it's a good way to say that, there's potential. The next thing video is in there. Is that what you're saying?
Let's hope.
I'm kidding. But no, I think the idea is that, there are plenty of companies that are household names now that were not 20 or 30 years ago. And they were, today, that might be a private business, but there are also some public versions of that could exist in the public markets today. And just very few people have the time frame or the as you said, the imagination to be able to be able to envision what a company could be in that long a time frame.
Yeah. And I would also say, like, there are, as we talked about earlier, there are companies today in our space which are garbage companies, but some manager is going to parachute into that company and transform that company into something much different, and then turn that into a very big company.
Well, gentlemen, this has been great. We talked about a lot of things. We talked about philosophy. We talked about position sizing. We talked about mistakes. We talked about quintessential stocks. So I think we've covered a lot. And so I'm just going to thank you guys for being on Compounders and sharing the long history of this firm and your involvement in the day-to-day. So thanks for being on Compounders.
Thank you, Ben. We appreciate it. We're fans of yours, and we're very honored that you had us on. Thanks.
Thanks for that.
Thank you for having us, Ben.